Woodside Energy Chief Executive Meg O'Neill has some pretty strong views on the government's proposed price cap on domestic gas. She says it's unnecessary, will discourage investment and could end up increasing gas prices. I caught up with Meg on the sidelines of Woodside's Investor Day this week and started by asking her about the recent fall in the share price of the energy giant.
I think investors are getting their arms around what the new post-merger business looks like. I think the expectations were very high, and we've been putting some news out this week that has helped recalibrate them. That said, the fundamentals of the business still are incredibly strong. We're forecasting 4% compound annual growth rate between 2023 and 2027. We've put out some forecasts for operating and free cash flows that show that the financial health of the business is strong. We've got a great balance sheet, and we're very well prepared to continue these investments as well as invest in new opportunities. So I think the market, will have a little bit of ups and downs, but the strength of the investment thesis is still very high.
Yeah, that 4% growth target. What are some of the key projects you're going to have to really get over the line to achieve those goals?
Yeah, so there's 4 projects that'll be starting up in the next few years. The first will be Mad Dog Phase 2, which is a BP-operated project in the Gulf of Mexico. That's in the final stages of commissioning, so we'll be expecting production from that next year. Sangomar, which is an oil field development that we're operating in Senegal. That's expected to start up and have first oil late in 2023. So we'll have a full year impact in calendar year 24. Then we've got a smaller development in the Gulf of Mexico, and then the big Scarborough field, which we're expecting to produce first LNG in calendar year 26. So a number of really big developments that will be coming online in the period.
Big issue this year has been cost of living for Australian businesses and consumers, particularly the price of resources, energy and gas. Government's got this price cap on gas as a potential thing to do. Should Woodside be paying a price on gas? Should there be a price cap?
So I think the gas market actually is working really well. And if you look at what's happened in Eastern Australia over this past winter, some of the drivers for the issues that we've experienced were coal-fired power stations were offline, coal supply chains were interrupted, renewable power generation was down, gas got called in to save the day. And the market worked. When demand was rising above what supply could readily provide, a price signal was sent. We actually ran an expressions of interest process for our gas coming out of the Bass Strait for 50 petajoules of gas. It was oversubscribed by customers who want to be responsible about securing their energy needs, and we're signing contracts at prices that both the customer and ourselves think are fair. So the market is working. There is no need for gas intervention, and the thing the government can do to support more gas is exactly that. Put mechanisms in place that will allow more gas to get into the marketplace. That's either through domestic developments or even things like being able to bring LNG across to the East Coast.
The other thing the government has is the domestic gas supply mechanism, the gas trigger, putting restrictions on exports to shore up local supplies. What's your reaction to this gas trigger if it does get pulled? Because the government's been talking for the past few months about pulling this gas trigger.
So I think the government needs to be mindful that much of our gas is going to customers in Asia who desperately need gas from Australia to support their economies and their citizens as well. The answer to this supply challenge is more supply. As I said, a policy framework that enables investment, regulatory certainty that if we want to move a project forward, we will be able to get regulatory approvals in a timely manner. And then things like the LNG import facilities. We're working closely with Viva to be able to bring LNG through their facility in Victoria, which would immediately address the challenge in Victoria.
But if they did pull the trigger, would it have an immediate impact on Woodside?
Look, it wouldn't affect Woodside. Our position in the East Coast gas market is a pipeline gas supplier, so all of our gas goes to domestic customers anyway. So that really wouldn't change. That wouldn't change anything for us.
The other issue that's been bubbling away has been the industrial relations reform. And BHP, they've said this week the bill will increase costs, reduce competitiveness and work against productivity. Do you agree with that view?
I agree completely.
What are your big concerns?
So Woodside has a direct relationship with all of our employees, our operations and maintenance employees, and that has served both parties well over the years. We're able to work closely with our employees. They understand the health of the business. our goals and their goals are very well aligned. We want to ensure our workforce is competitively paid. We want to make sure we have the policy framework so that they can, find the right balance in work and life. So we've got a very effective working relationship. Things like multi-employer bargaining, where the outcomes of what we pay our employees is somehow linked to other employers, it makes no sense. And it will yield those results that BHP highlighted, higher costs for the business and reduced international competitiveness.
Yeah, one example of multi-employer bargaining that's been talked about has been, say, employees at Santos go on strike over pay. Employees at Woodside could then potentially join them in solidarity. How big a fear is that for you?
Well, there's so many uncertainties about how this agreement would play out. The water-related businesses, that's absolutely a fear. I worked in Norway, and Norway does have multi-employer bargaining, and the unions cherry pick. They'll say, this year we're mad at employer X, and so we'll strike their facilities, even though the pay dispute had nothing to do with that particular employer. So it really is quite detrimental. And the products we produce, we sell on a global landscape, and other sellers don't face these pressures.
What's your direct communication been like with senior government ministers over both the gas trigger and the IR reforms?
Oh, it's been pretty clear. We've been talking to government about the energy crisis on the East Coast. The best way to solve the energy crisis is more supply, and there are things that they can do today, and there are things that can be done in the future to ensure the long-term prosperity. All of these measures are short-term. A price cap might feel good today, even if you can figure out how to make it work. But the end outcome is going to be less gases in the market, and the energy supply crunch is even worse in a few years' time.
Also on the IR topic, this week you lost Fiona Hick, one of your really senior employees. How big a loss is she going to be for Woodside?
So Fiona was with us for almost 22 years. We really value all of the leadership that she brought to the organization. She led our HSE team, she led strategy and planning, and her last role was heading up our Australia operations and led us through the very disruptive period of COVID. So we're very thankful for her contributions, but we wish her well. It's not very often that you have a chance to step up into that sort of leadership role that she's accepted. And it gives us a chance to look within our organization and maybe look outside as well, and find someone to take Australian operations forward. So I feel good about the depth of our bench strength and the ability to continue running the business effectively.
And just looking at the outlook, how volatile is the energy market right now and the outlook for energy prices?
Well, I think it's quite striking, actually, that in the past 2 years, we've seen record lows and record highs. The volatility is unprecedented. A number of factors are at play. When COVID hit, that was a bit of a black swan event that caused the prices to fall. What we've seen, though, is that the market is tight. There's been underinvestment in the sector globally. As nations come out of the pandemic, there's a lot of desire to get economies moving again. Demand is going up for our products. But again, you pull the crystal ball out, and there's a lot of talk of recession. There's questions about what's going to happen in China. So we're at a point in time where there's tremendous uncertainty.
And when there is a potential global recession, investors will tighten up their wallets, won't invest as much money. Is that a concern for you when you're looking to sell down some of your big projects like Scarborough?
So the potential partners that we're talking to on Scarborough recognize the long-term value of LNG. They understand that this is a commodity for the future. This is a commodity that will be a part of the decarbonization of the world. If you think about two factors, one, renewables need something to firm them. Gas is the lowest carbon intensity firming option other than nuclear, which a lot of countries don't want to use. And then the second factor is gas is not just used for power generation, it's used in industrial manufacturing. It's very hard to replace gas for those purposes. So gas is very much going to be part of the world for decades to come, and the buyers that we're talking to see through the short-term ups and downs.
Meg O'Neill, Chief Executive at Woodside, thanks for your time today.
Thank you.